Hey everyone, after touching a new high recently, Nifty has cracked below levels of 18,000 and Nifty is now back to the similar levels where it started this year. In fact, if you observe, there is heavy correction especially in mid-cap and small-cap sector. And more than anything, I'm sure your individual portfolios would be bleeding even badly. If you look at it, it's been 14 months since the markets are in correction mode. Last time Nifty touched a high of 18,400 in October 21 and now we are about to close 2022 with levels below 18,000. And like I said, if you have started investing in 2022, then your individual portfolios would be down heavily. So stock market is really testing the patience level since last 14 months. Although Nifty touched a low of 15,200 in June month, so from those levels it is still up 18%. The question is, can Nifty again test June lows of 15,000? To answer this question, it is very important to understand why stock markets are falling. And then we'll try to understand what we can expect in the near term. Also, I would like to highlight why individual portfolios are bleeding even badly. And one big mistake you should avoid in your portfolio during this falling market. Alright, let's get started. Ultimately, stock market movement is a function of economic growth. If the economy would grow, markets would grow. And if the economy would fall, markets would fall. While in the short term, stock market can behave irrationally, in the long term, you can't segregate economic growth and stock market. It has to go hand in hand. So the simple reason for fall in stock market is slowdown in economic growth. Why economic growth is slowing down? I'll come to that later. Here it is very important to look at global economic growth and Indian economic growth. If you look at global economies including US, it is already in recession. As a result, the US stock market has tanked badly. Year to date, Nasdaq index is down 34% and majority of stocks in US have fallen badly, especially the tech stock. For example, Amazon shares have tanked 55% from its peak and has become the first company to lose market cap of $1 trillion. Just to give you an idea, entire Indian economy is $3 trillion. So you can imagine how bad the correction is. Likewise, Meta, the parent company of Facebook, WhatsApp, Instagram, is down nearly 70%. Nvidia shares are down more than 50%, and the list goes on. So let us first try to understand why US stock market has tanked badly and then we'll come to Indian stock market. The reason being that there is a big impact of US market and its growth on Indian economy. So you can't just look at Indian markets separately. You have to look at US market as well. Like I said, the major reason for fall in US market is recession. US economic growth is slowing down and there are already big layoffs in the US market. To understand why US economy is slowing down, it is important to understand the role of interest rates. If you recall, during COVID when US economy crashed badly during lockdown, US Fed started printing trillions of dollars to support the economy and they reduced the interest rates to near 0%. That resulted in huge liquidity in the US market because when you get loans at near 0% interest rate, everyone would want to buy a new house and expand the business on loan. So basically money started flowing crazily in US economy due to trillions of dollar printing and near zero interest rate. And that money got pumped into stock market. Hence the US market jumped exponentially during COVID fall. And since US institutional investors invest billions of dollars in Indian market as well, we saw huge inflow of FII money into Indian economy. Hence, Nifty zoomed from lows of 7,500 during COVID and touched a high of 18,400 within 15 months. However, due to huge liquidity in the US market, the demand for products and services started increasing. And then we saw economy opening up and people who were sitting at home for more than a year started going out. And we saw revenge shopping and revenge travel. Basically, there was huge demand in US economy that resulted in crazy inflation. The inflation was so bad that it zoomed from levels of below 2% to highs of 9.1%. Mind you, ideally, US Fed want to keep US inflation below 2%. As a result, everything became expensive, right from your home rent to flight tickets, hotel tickets, and so on. Obviously, US Fed had to control this crazy inflation. So they started increasing interest rates. In fact, US Fed hiked interest rates 7 times consecutively in 2023. With this rate hike, the interest rate in US is now the highest in last 15 years in the range of 4.25 to 4.5%. And that resulted in huge liquidity crunch and even the bond yield in US became very attractive. Since the US institutional investors made good profit during low interest rates, they started booking profits. Hence, we saw huge correction in US market. Moreover, it is very clear that US economy would continue to face slowdown in 2023 and US Fed has already hinted towards more rate hikes. All this development has resulted in panic selling in US. As far as Indian economy is concerned, the situation is not that worse. Although we are also facing the same inflation problem, but it is not that bad. And as far as recession is concerned, India is one of the few large economies that is growing at a healthy rate. So there is no question of recession in India. However, you can't separate India from rest of the world. After all, everything is linked in this global economy. Now, similar to what happened in US, we saw a sharp jump in Indian stock market during COVID as billions of dollars started pumping into Indian economy, and when Nifty saw a sharp jump from lows of 7,500, many retail investors started pumping money into the Indian market. But majority of them entered late when Nifty already zoomed a lot. As a result, when Nifty touched a high of 18,500 around last year, and then we saw a huge selling from FIIs from Indian market, and Nifty crashed to lows of 15,200 in June 22. However, again, within 6 months, Nifty jumped more than 20% and made a high of 18,800. Although when the global economy was struggling, this jump in Indian stock market was not justified. In fact, while US market was still down 30% from its peak, it was really surprising to see Nifty touching a new high. So on one side, while Indian economy is looking robust, global economies are struggling with growth. And since stock markets are linked globally, as a lot of money flow from global market into Indian economy, Indian stock market can't sustain high levels when US market is down 35% year to date. Of course, another reason for this panic in stock market is also due to sharp spike in COVID cases. Although I don't think COVID can be a major problem again. It is mainly the high inflation and high interest rate to control the inflation that is negatively impacting the economic growth globally. Hence, in the near term, there can be possibilities of further correction. The simple reason is we are in a high interest rate environment to control the high inflation. And this high interest rate would result in fall in demand and ultimately fall in earnings. And when earnings would fall, stock price would also fall. So until and unless there's a clear sign of inflation cooling off, especially in the global market, we can see further downtrend in the stock market. And it may take another 6 months for inflation to come down to a decent level in US. That means in the near term, there can be more pain ahead in both US and India. Will Nifty again touch June lows of 15,000? We can't deny the possibilities. However, you can't wait for that perfect time. Last time when Nifty touched levels of 15,200 in June 22, many investors were hoping for Nifty to touch 14,500 or even levels of 14,000. So if you wait for that perfect time, you will miss out on this opportunity to add great stock at lower level. Now next question is what to do now? See, if you are a long-term investor, then you need to keep patience. It is not the first time when stock market has fallen. In fact, during early 2000, Nifty was down nearly 50% during February 2000 till May 2003. That's more than 3 years. Nifty kept on falling continuously to touch a low of 950. And today, it is near the levels of 18,000. And there are many more such examples in the past. In fact, if you are a long-term investor and in the accumulation stage of your investment journey, this fall would only create buying opportunities. The only problem is majority of investors lack patience and conviction. When the stock falls 40-50% and that too for almost a period of over 1 year, it creates panic. But that is actually the time to accumulate quality stocks. So from here, those who will remain invested and utilize this fall as an opportunity to add stocks in systematic manner will certainly come up as winners. Although like I said, it could take a few more months for the economy to revive. But everyone knows that India's future is very bright. Now there is one problem I want to highlight. As mentioned during the beginning of this video, while Nifty has not fallen that badly, the individual portfolios would have fallen badly. Now what is the reason for this? Because if you analyze Nifty in terms of sectors, the majority of growth has come from PSU sector. The most popular IT sector of 2021 is still down 27% year to date. Similarly, pharma sector has seen sharp correction. And majority of stocks that have seen growth during 2021 have corrected in 2022. Now many investors make one mistake in stock market. They chase stocks that have already generated high returns in last 6 to 12 months. And by the time they invest the money, the stock has already rallied a lot and start falling. In this process, retail investors end up buying stock at high level and sell them at low level. Whereas ideally, as a long-term investor, you need to look at quality stock that have corrected significantly. So don't try to add new stocks every time in your portfolio. If you have invested with proper research, the chances are high that you already have great stocks in your portfolio. You just need to accumulate them systematically. So from here, Indian markets can see further volatility and correction, but nobody knows the exact bottom. The best approach is to break your money in 3 to 6 equal parts and invest systematically. I believe that next 3 to 6 months will create a great buying opportunity in Indian market. And this could be the last major correction before we see the next bull rally. Of course, ultimately everything will boil down to inflation, but the way crude oil prices have fallen and inflation has shown downward trend, hopefully inflation will come down to much better levels in the next 6 months. By that time, a further 10 to 20% correction in the market would make it even more attractive. And then we can probably see money flowing back into equity market for the next set of bull rally. While 6 months is a very short period to predict market level, I am certain that 2 to 3 years down the line, Indian markets would be touching a new high. And long-term investors would be surely rewarded for keeping patience and investing systematically during this rough time. Thanks for watching this video. I'll see you next video. Till then, take care.